Welcome to Spiedel's California Minute. I'm your host, Catherine Zidane. This week we're discussing non-resident sole proprietor income taxability in light of several Office of Tax Appeal decisions. Spiedel's federal and California tax update will get you updated on everything you need to start the upcoming tax season, and there are live webinar and in-person seminar options available. Go to caltax.com for details. An issue facing out-of-state sole proprietors is whether revenues from services performed in their state of residence for California customers is considered California source income subject to California income tax. The first decision by the Office of Tax Appeals that addressed this issue was the appeal of Larson in 2018. In Larson, the OTA ruled that the taxpayer had to have some form of physical presence in California for the service revenues to be subject to tax. But that decision was non-precedential. Less than a year later, the OTA issued a precedential decision in appeal of Bindley, reversing the holding in Larson. The Bindley decision is the current rule on this issue. In Bindley, the OTA interpreted the same statutes and regulations that were examined in Larson. However, they found that a non-resident sole proprietor who performed all of his work outside California was subject to California tax on his income from California customers, even though he had no physical presence in California. The Bindley case considered whether California could tax an Arizona resident on income he received for screenplays he wrote in Arizona and sold to two California LLCs. When the FTB received two 1099s from the LLCs showing that the taxpayer had received $40,000 from them, the FTB sent the taxpayer a request for tax return. The taxpayer responded that he didn't have a filing requirement because all of his services were performed in Arizona, so he didn't have any California source income. Interestingly, the taxpayer in Larson performed all his services in Idaho for his California customers, and the OTA held that the taxpayer did not have any California source income and was not required to file a California return. Reversing the decision in Larson, the OTA found that Bindley did perform services in California because he received income from California customers. Because he was performing services both inside and outside California, he should have apportioned his income between the two states, with the income from his California customers sourced to California. Since Bindley was decided, the OTA has issued a series of decisions that provide us with some insights to determine if and how an out-of-state sole proprietor's income should be taxed. First, determine if the sole proprietor received the benefit of the service in California. If not, then the income is not considered California source income. The FTB will simply look at the payer's California address on Form 1099 NEC. If a California address is listed, treat that income as California source income. However, just because payment was made from California doesn't mean that the income is California source income, because the benefit of the sole proprietor's services may not actually have been received in California. Frequently, a sole proprietor's customer may be located in California, but the sole proprietor may be providing services to the customer's customer, who is located outside California. Similarly, the customer may pay the sole proprietor from their offices in California, but the sole proprietor may actually provide the service to the customer in another state. It's important for taxpayers to review the FTB's market-based sourcing rule and Legal Ruling 2022-01 to determine where the benefit was received. Second, determine how much of the California source income is actually taxable by California. Just because the income is sourced to California does not mean that the income is automatically 100% taxable to California. Because California's corporate tax apportionment formula applies to a sole proprietor's multi-state business, the sole proprietor's California source income is included in the numerator of the taxpayer's California apportionment single sales factor formula. In appeal of Sheward, the FTB assessed tax against an Ohio resident who provided horse racing stewardship services to the California Horse Racing Board. Although the OTA agreed with the FTB that the Ohio resident was subject to California tax on her earnings, in this precedential opinion, the OTA held that only a portion of the California income was subject to tax. Spiedel's California Tax Letter is a monthly newsletter that will ensure both you and your clients are up to date with California tax law changes. You can get subscription details and download a sample issue at caltax.com under Publications. That's all for this week. Join us next time for another episode of Spiedel's California Minute.